What's up, family? Andre here. On this episode, we're going to dive into the world of trading options. Options have become very popular during this pandemic because it allows you to participate in this market from home, and many people have gotten involved in the options market. So on today's episode, we're going to explain what options are, the terminology that goes along with it that is based in Greek terminology, the pros and cons to being a participant in the options market, and how it impacts you and your money. But before we get started, please don't forget to smash that like button, hit the subscriber button, as well as the bell next to it in order to get updated weekly content. What are options? Options are financial instruments that are derivatives that are based on the value of the underlying securities, such as stocks. An options contract offers the buyer an opportunity to buy or sell, depending on the type of contract that they hold, the underlying asset. Like futures contracts, the holder is not required to sell the underlying asset if they choose not to. All options allow the holder to buy a specific asset at a stated price during a specific time frame. Options are a very versatile product. These contracts include both a buyer and a seller, where the buyer pays an options premium for the rights that are granted within the contract. There are two important distinctions that need to be made between call options and put options. Each call option has a bullish buyer and a bearish seller, while put options has a bearish buyer and a bullish seller. Option contracts usually represent 100 shares of the underlying security, and the buyer will pay a premium for each one of those option contracts. For example, an option contract with a premium of 25 cents times 100 shares, the cost to the buyer will be $25. The premium associated with option contracts is based upon the strike price. What is the strike price? That is the price of being able to buy or sell the underlying security until the expiration date. Another important consideration with option contracts is the expiration date factor within the premium price. Just like a carton of milk that's in your refrigerator that has an expiration date, option contracts have an expiration date on which that option contract must be used. The underlying asset will determine the use-by date. For example, with stocks, the third Friday of the option contract month is the expiration date. Traders as well as investors will trade in options for a multitude of reasons. Option speculation allows a trader to hold a leveraged position in an underlying asset at a much lower cost than if they actually bought the shares of that underlying asset. Investors often use options to hedge or reduce risk exposure to their portfolio. In some cases, an options holder can actually generate income if they buy call options or become an options writer. There are two key metrics for options traders to consider that are critical to help them make decisions. That would include an options daily trading volume and open interest. These two key metrics are critical for options holders to make informed decisions within the option market. In terms of exercising options, there are distinctions between countries. American options can be exercised anytime before the expiration date, while European options can only be exercised on the expiration date or the exercise date. What does exercising mean? Exercising means that you have the right to buy or sell the underlying security. These variables are often called Greeks because they're associated with Greek symbols. Each risk variable of an option is an imperfect assumption or relationship of that option to an underlying variable. Traders often use Greek symbols in terms of values such as delta and theta to assess the risk of certain options and to be able to manage option portfolios. Let's take delta. Delta is the rate of change of the option and a dollar change in the underlying asset. In other words, it's the price reaction of the option to the underlying asset. Delta of a call option has a range between 0 and 1, while delta of a put option has a range between 0 and -1. Let's look at this example. Let's assume a trader has a call option with a delta of 0.30. If the underlying asset increases by $1, the option price would theoretically increase by 30 cents. Options traders, delta also represents the hedge ratio to create a delta neutral position. For example, if you own an American call option with a delta of 0.20, You will need to conversely sell 20 shares of stock to be fully hedged. Options traders, delta represents the hedge ratio to create a delta neutral position. For example, if you have an American call option with a delta of 0.50, you will conversely need to sell 50 shares of stock to be fully hedged. In addition, the net delta for a portfolio of options can also be used to obtain the options hedge ratio. A much less common use of an options delta is its current probability that it will expire in the money. For example, a delta with a 0.50 call option has an implied 50% probability of finishing in the money. Theta represents the rate of change between an option's price and time, or time sensitivity. It's also known as the option's time decay. Theta represents the amount an option would decrease as the time toward expiration date decreases. For example, let's say an investor is long on an option with a theta of negative 0.30. That means that option's price will decrease by 30 cents as the time to expiration decreases. Moreover, if you put that in terms of dollars and cents, over a 3-day period, that option would decrease by 90 cents. Theta increases when options are at the money, and it decreases when options are in and out of the money. Options closer to the expiration date also have an accelerated time decay. Long calls and long puts usually have a negative theta, while conversely, short calls and short puts have a positive theta. Stocks, for example, which doesn't have its value erode over time, would have a 0 theta. Gamma represents the rate of change between an options delta and the underlying asset. This is called second-order price sensitivity. Gamma indicates the amount delta would change by a $1 move in the underlying security. For example, let's assume an investor has a long call option on stock A. If stock A has a delta of 0.50 and a gamma of 0.10, a $1 increase or decrease of stock A will result in the call option's delta increasing or decreasing by 0.10. See, gamma is used to determine how stable delta is. Higher gamma values could indicate that delta could change dramatically in response to even small movements in the underlying asset's price. Gamma is higher for options that are at the money and lower for options that are in and out of the money. It also accelerates as the expiration date approaches. Gamma values are usually smaller the further they are away from the expiration date, while options with longer expiration dates are usually less sensitive to changes in delta. When the expiration date gets closer, gamma values are usually larger. Price changes tend to have more of an impact on gamma. Options traders may opt not to hedge delta, but to hedge on gamma to remain delta gamma neutral, meaning as the underlying price moves, the delta will remain close to 0. Expiration date approaches. Gamma values are usually larger because they are more sensitive to price change. Options traders may opt to not hedge delta, but to hedge gamma in order to remain delta gamma neutral, meaning as the underlying asset price moves, the delta will remain close to 0. Vega represents the rate of change between an option's value and the underlying asset's implied volatility. It's the sensitivity of the option to volatility. Vega represents the amount an option's price will change given a 1% change in implied volatility. For example, an option with the Vega of 0.30 would change by 30 cents if the implied volatility were to change by 1%. Because increased volatility implies that the underlying asset will experience extreme values, a rise in volatility will correspondingly increase the value of an option. Conversely, a decrease in volatility will have a negative effect on the value of an option. Vega is at its peak for at-the-money options that have longer times before the expiration date. Rho represents the rate of change between an option's value and a 1% change in the interest rate. In other words, it's its sensitivity to changes in the interest rate. For example, a call option with a rho of 0.10 and a price of $1.20. If there is a 1% change in interest rates, the price would now be $1.30. The opposite would be true for put options. ROE is at its peak with at-the-money options that have longer times before expiration date. Call options let the buyer purchase the underlying security at the stated strike price before the expiration date, called the expiry. The holder is not obligated to buy the selected security or not unless they want to. Risk to the call option buyer is limited to the premium that is paid. Any fluctuations in the underlying stock will have no impact on the buyer. Call option buyers are bullish on a stock and believe that the share price will rise above the strike price before the option expiry. If the investor's bullish outlook is realized and the share price rises above the strike price, they can exercise the option, buy the stock, and then sell that stock at the current market price for a profit. Their profit on this trade is the market share price minus the strike share price plus the expense of the option, which includes the premium and any brokerage commissions that were paid to place this order. Will be multiplied by the number of option contracts purchased, then multiplied by 100, assuming that each contract is worth 100 shares. However, if the underlying stock does not rise above the strike price before the expiration date, the options will expire and are worthless. The holder is not beholden to now buy that stock, but would lose the premium that was associated to that call. Call options is known as writing a contract. The writer receives the premium fee. In other words, an option buyer will pay the premium to the writer or the seller of an option. An investor who sells a call option is bearish and believes that the underlying stock price will fall or remain relatively close to the option strike price during the life of that option. Prevailing market share price is at or below the strike price by expiry, the option expires and is worthless to the call buyer. The option seller keeps the premium as their profit. Option is not exercised because the option buyer would not exercise the option at a strike price higher than or equal to the prevailing market price. Market share price is more than strike price at expiry. The seller of that option must sell the shares to the buyer at the lower strike price. In other words, the seller must sell shares from the portfolio or buy the stock at the prevailing market price to sell to the call option buyer. As clearly evident through this process, the risk exposure to the call writer is significantly more than the risk exposure to the call buyer. The call buyer just loses the premium in this process. A writer can incur infinite amount of risk because if the stock continues to increase, that will result in significantly more losses for the writer. Put options are investments where the buyer believes that the underlying stock market price will fall below the strike price on or before the expiration date. Can sell shares without an obligation to sell at the stated strike per share price by the stated expiration date. Buyers of put options want the stock to decrease. The put option is profitable when the underlying stock price is below the strike price. Prevailing market price is less than the strike price at expiration. The investor can exercise the put, and they will sell shares at the option's higher strike price. If they so desire to replace these shares, they can turn around and buy those shares on the open market. Profit on this process is the strike price minus the market price, plus any expenses associated with this transaction, which would include premiums and any broker commissions that were paid to place the trade. Then it is multiplied by the number of option contracts purchased, then multiplied by 100, assuming each contract is worth 100 shares. Of a put option will increase while the underlying stock decreases. Conversely, the value of a put option decreases as the underlying stock price increases. Buying put option is only limited to the premium associated with buying those options when they expire worthless. Selling put options is also known as writing a contract. A put options writer believes that the underlying stock will either stay the same or increase over the life of the option, making them bullish on the shares. In this situation, the option buyer has the right to make the seller purchase shares of the underlying asset at the strike price at expiration. The underlying stock price closes above the strike price by the expiration date. The put option expires worthless. The maximum profit is the premium. In this scenario, The option is not being exercised because the option buyer would not sell the stock at a lower strike share price than the market, and in this case, the market is paying more. However, if the stock market value falls below the option strike price, the put writer is obligated to buy the shares of the underlying stock at the strike price. In other words, the put option will be exercised by the option buyer. The buyer will sell their shares at the higher strike price because it's higher than the market value. For the put option writer happens when the market price falls below the strike price. Then at expiration, the seller is forced to buy the shares at that strike price. The losses can be significant depending on how much the stock has appreciated. The writer or the seller can either hold on to the shares and hope that it rises above the purchase price, or sell the shares and take a loss. The loss can somewhat be offset by the premium that's already been received. In summary, what are some of the advantages and disadvantages of putting in an option strategy within your investment portfolio? Advantages: a call option buyer has the rights to purchase assets at a lower price than the market when the stock price is increased. Option buyer can profit by selling a stock at the strike price when the market price is below the strike price. Option sellers receive a premium fee from the buyer for writing an option. In a falling market, the put option seller may be forced to purchase options at a higher price than they would in the market. Option buyer can profit by selling a stock at the strike price when the market price is below the strike price. Market, the put option buyer may be forced to purchase an asset at a higher strike price than they would in the market. Call option writer faces infinite risk if the stock continues to rise significantly and they are forced to buy shares at a higher price. Buyers must pay an upfront premium to the writers of that option. And that is it. Hopefully now you have a better understanding of the options market, the thorough ins and outs of the process, the advantages and the disadvantages to having options included in your portfolio, and how it can impact you and your money. Please don't forget to smash that like button and hit that subscriber button as well as the bell next to it in order to receive updated weekly content. Thank you for tuning in.